you're investing your money, or at least you think you are. Because what if I told you most of the decisions in modern investing aren't even being made by humans anymore? Welcome to the new world of finance, where this is AI, not financial advice. And the strange part, it doesn't feel that different. There's no dramatic switch, no moment where Wall Street culture suddenly disappeared. No headline saying humans replaced by algorithms. Just a slow transition from intuition to automation, from storytelling to statistical models. Because not too long ago, investing was deeply human. You had traditional money managers, financial advisors in expensive suits, people doing fundamental analysis, reading earnings calls, analysing balance sheets, and crafting narratives around stocks. This company feels strong. The management looks confident. This stock is undervalued. It sounded intelligent. Sometimes it even worked. But underneath it all, it was human-driven investing. And human investing has a problem. Bias, emotion, overconfidence. Because investment intuition is just a polite way of saying guesswork with experience. And for a long time, that was fine. Because markets weren't efficient. Information asymmetry existed. Data moved slowly. If you had better information, you had an edge. But then everything changed. Data became free, real-time market data became accessible, research tools went mainstream, and suddenly, the information advantage disappeared. Everyone had access, which meant human judgment started losing its edge. Enter the machines. Quantitative investing didn't ask, is this a good company? It asked, what's the probability of this outcome? No stories, no narratives, just data-driven investing. Statistical models, algorithmic trading, machine learning in finance, and it worked. Quant hedge funds started dominating, using systematic trading strategies to exploit market inefficiencies. One of the most famous examples, Renaissance Technologies, and inside it, the legendary Medallion Fund, built by Jim Simons, a mathematician, not a traditional investor. No earnings calls analysis, no market storytelling, no CNBC interviews, just math. And the results? Insane. For decades, the Medallion Fund delivered some of the highest annualized returns in history, even outperforming legends like Warren Buffett by a massive margin. That's when the industry realized something uncomfortable. Math beats intuition. Probability beats opinion. Systems beat humans. And while quant funds were quietly taking over institutional investment strategies, something else was happening at the retail level. Because average investors started noticing something. Active fund management was underperforming consistently. Benchmark underperformance wasn't the exception, it was the norm, so people started asking a simple question: why am I paying higher fees to do worse than the market? And that's where passive investing took over. Index investing, ETFs, exchange-traded funds, low-cost investing strategies. Instead of trying to beat the market, people started buying the market. A full market replication strategy. No guesswork, no stress, just compounding returns over time. And it worked, so capital started moving. Institutional investors began reallocating, moving away from traditional managers toward quant funds, private markets, and in-house investment teams. Fees started compressing. Assets under management shifted. The old model began to break. But there was still one problem. People still needed portfolio management, asset allocation, portfolio rebalancing, diversification strategy, tax optimization, the boring stuff. And that's where the next wave arrived. Robo-advisors, platforms like Wealthfront and Betterment, automated portfolio management, algorithm-based investing, digital wealth management, no meetings and no paperwork, no financial advisor charging you 1% a year, just automation. You answer a few questions, risk tolerance profiling, time horizon, goals, and just like that, you're assigned a portfolio. But here's the truth most people don't realize. It's not really personalized. It feels personalized, but it's standardized. You're placed into a model portfolio shared by thousands of other investors. Because robo-advisors aren't trying to generate alpha. They're not competing with quant hedge funds. They're replacing the middleman. And that's the real story here. This isn't about better investing, it's about industry disruption. Because for decades, financial advisors weren't just selling performance, They were selling access. Access to markets, access to information, access to opportunity. But now, data democratization has changed everything. Markets are transparent, information is free, execution is instant. So the middleman tweet becomes optional. And when access becomes free, technology replaces the gatekeeper, just like travel agents, just like stockbrokers. Now it's happening to finance. Automation in finance, AI in investing. Digital platforms scaling globally. This is the platform economy colliding with Wall Street, and the shift is structural. Middleman elimination, cost efficiency in investing, scalability in financial services, from fee-based advisory models to subscription-based fintech, from exclusivity to accessibility, from human judgment to algorithmic systems. But here's where it gets uncomfortable, because this isn't just about efficiency, it's about trust. Do you trust automation with your money? Do you trust algorithms over human judgment? Because this is the core tension. Technology versus intuition, math versus emotion, efficiency versus personalization. And the answer isn't simple, because while AI can optimize portfolios, it doesn't understand your life. It doesn't feel risk. It doesn't experience fear. It doesn't know what losing money means to you. It just calculates, which is powerful, but also limited. So when people say AI is taking over investing, they're not wrong, but they're also not telling the full story. Because this isn't about replacing humans completely, it's about redefining their role, from decision makers to overseers, from stock pickers to system designers, from intuition to interpretation. And that's where we are right now, in the middle of a transformation, where finance is no longer just about money, it's about technology. It's about data. It's about who controls the systems and how those systems shape outcomes. So the next time you invest, or open an app, or follow a strategy, ask yourself something simple. Is this advice, or is this an algorithm? Because in today's world, the line between the two is disappearing. And maybe that's the real shift. Not that AI is replacing investing, but that it's quietly redefining what advice even means. Because when decisions are driven by data, when portfolios are built by models, when outcomes are optimized by code, what you're really trusting is the system behind the screen. And if you made it this far, you're already thinking one level deeper than most people. So do us a small favor, hit the like button, subscribe to the channel, and stay connected, because here we don't just follow trends, we break down the systems behind them.